What up guys, it's Nick here from Nick's Taxes, and in today's video we're going to talk about 3 US dividend stocks that you want to have in your portfolio. Whether there's stock market uncertainty like there is right now, or when times are good, these stocks perform year in and year out. And make sure to watch till the end of the video as I'll explain some tax saving tips on these dividend stocks, so you'll want to stay tuned for that. But without further ado, let's get right into the video and into these 3 dividend stocks. Okay, so the first stock that we're going to look at is Coca-Cola. It trades on the New York Stock Exchange under the ticker symbol KO. Currently sells at about $48 per share and has a dividend yield of 3.4%. The dividends are paid out quarterly. Now, Coca-Cola, the nice thing about them is they have an incredible brand reputation, and it's not just the classic Coke drink that you think of. They own a ton of brands and a lot of different drink brands that you are familiar with. I'm talking about Powerade, Dasani, Vitamin Water, Sprite, and Fanta. These are all consumer staples in the soft drink industry. The best thing about Coca-Cola is that they've been increasing their dividends for the past 50 consecutive years. So in the dividend world, they are labeled as a dividend king. Now, we talk about dividend aristocrats and dividend kings. Dividend aristocrats are companies that have increased their dividend over 25 plus years. Dividend kings are those companies that have increased their dividends for 50 plus years. So Coca-Cola is one of the few in the king category, which has a lot to be said. It also implies that they won't be cutting their dividend unless management absolutely has to. So as a quality dividend stock, Coca-Cola is one that you want to have in your portfolio. The next stock that I want to look at is 3M. 3M trades on the New York Stock Exchange under the ticker symbol MMM. 3M for the company 3M. It currently trades at about $158 per share with a dividend yield of 3.7%. They also pay their dividends out on a quarterly basis. Just like Coke, 3M is in the dividend king category, which means they've been increasing their dividend for the past 50 years plus. 3M is, you may know them from some of their consumer brands like Scotch tape and Post-it notes, but they do a lot more than that. They're in the safety and industrial industry, the transportation industry, the electronics industry, and also the healthcare industry. So 3M has their hand in a lot of the things that run the US economy. They're not going anywhere. Alrighty, and now to the third and final stock for top US dividend stocks is going to be Proctor & Gamble. Trades on the New York Stock Exchange under the ticker code PG. Its current share price is around $133 per share, and it has a dividend yield of 2.37%. They also pay their dividends out quarterly. Again, now Procter & Gamble might not be a company that you know of or have heard of, but I can guarantee you know some of the companies that they own. They have their hand in a ton of different areas that we call consumer staples. So these are things that you're buying and using every single day. Whether the stock market is soaring or if we're in a recession, I guarantee you use these products. I'm talking about hygiene, oral care, home care, laundry, baby, they have it all. You'll be familiar with their brands like Gillette, Crest, Swiffer, Pampers, and even Pantene. So Procter & Gamble, again, has their hand in a lot of things that we use on a regular basis, which means that their stock is pretty steady. They've actually increased their dividend as of April 2020 by 6%. So it's just another sign that these guys are committed to their dividend. And like the 2 previous dividend stocks that we talked about, Procter & Gamble is a dividend king. And unlike 3M and Coca-Cola, who have increased their dividends for the past 50 plus years, Procter & Gamble have been increasing their dividends for the past 60 plus years, which is incredible. So those are the 3 quality US dividend stocks that you want to have in your portfolio. Now, in my previous video where I talked about some Canadian dividend stocks, I talked about the hydro industry. So I didn't talk about that in the US stocks, but there are some good quality US dividend stocks that are in the utilities and the hydro and the energy industry that I didn't touch on. I wanted to touch on more US specific and more US unique dividend stocks that we don't necessarily have in Canada on the Toronto Stock Exchange. So these are companies that obviously are huge staples in different kind of industries that don't have the same kind of crossover effect that we have in Canada. Obviously, no matter where you go, the energy and utility sector is probably going to be a quality play. But I wanted to look at some of these consumer staples that we don't necessarily have on our stock exchange. Now, speaking of Canada and the USA, there is an agreement between Canada and USA that if you have your investments, your Canadian investments in something like a TFSA or a non-registered investment account, that they will take, the IRS, the US tax authorities, will take a 15% withholding tax off of your dividends. So that means that is the tax percentage or the tax portion that you need to pay to the US for the dividends that you earned. Now, you can't avoid that in a TFSA or a non-registered savings account because the US doesn't see the Canadian tax-free savings account as a tax-free savings account. You can have those stocks in a TFSA and they will be tax-free for Canadian tax purposes, but you will still have that 15% withholding tax because you're paying that to the US, and the US has their own rules. Now, there is one way to avoid that 15% withholding tax in Canada, and that is to hold it within a registered retirement savings plan, or better known as an RRSP. I talk about RRSPs and TFSAs in other videos. If you want to check them out, I'll link them in my description. But essentially, the US does see the RRSP as a similar account that they have in the US and will treat it as a tax-free account. So your investments or whatnot will grow tax-free within the registered retirement savings plan, whether you have US investments or Canadian investments inside of it. So if you want to save a little bit of tax, these companies would be great to have in your RRSP compared to your TFSA. Not necessarily that 15% is a whole lot or it's a bad thing, just something that you need to be aware of as an investor investing in the US side of things. Now, if you're watching this and from the US, it's worthy to take a look at what's called an IRA, individual retirement account. There's a Roth IRA and a traditional IRA, and those would be worth taking a look at to have these type of investments because, like the RRSP, your investments can grow tax-free within those accounts. So, if you enjoyed this video, if you got value out of this video, please give it a thumbs up and please consider subscribing. It helps my channel grow a lot. I'd really appreciate the support. And let me know in the comments below if there's a quality stock that I didn't consider, or if you'd like me to make another video on, please let me know what you think. And I will see you guys in the next video. I'm Nick from Nick's Taxes, and happy taxing.